You're listening to the Economics and Country Risk podcast from S&P Global Market Intelligence. In each episode, our experts will provide you with the where, how, and when to make decisions that transform your business.
Hi, I'm Kristen Hallam, content strategist at S&P Global Market Intelligence, and your host for this episode of the Economics and Country Risk podcast. The tightening of global monetary conditions over the past year has driven a softening of house prices, which in some key markets are expected to decline in 2023 and 2024. The degree of impact, of course, varies by market. In this episode, the third and final installment of our series on housing markets around the globe, we zero in on select markets in the Asia-Pacific region. Joining me from S&P Global Market Intelligence are Todd Lee, Chief China Economist, and Bree Neff, Director, Asia-Pacific Economics. Thank you both for being here today. So, obviously, APAC is not one homogeneous market where all house prices are moving in the same direction. Where are you seeing interesting movements in prices currently? Bree, let's start with you.
What's notable to date in the data is that we've seen sharp turnarounds in prices in places such as Australia, New Zealand, and South Korea. This largely arose from lower interest rates and shifting housing demand in the early part of the pandemic that was then exacerbated by rising construction costs in 2022. This drove really quick house price appreciation. We saw year-on-year growth of 16 to 28% in these markets. But once monetary policy tightening kicked in, home prices have quickly turned around and shifted into decline. Currently, the price declines are looking at 5 to 15% year on year, depending on the market and the data source for the country. That said, prices appear to be nearing their trough in Australia and South Korea. And we expect New Zealand's prices should probably bottom out sometime this year as well. Another market which is turning a corner is Hong Kong's market, where prices have started to turn around after a contraction that commenced in early 2022 as part of that economy's broader economic and COVID containment measures. When we get to broader APAC and emerging markets in particular, I'll pass it to Todd to talk about China here in a second, but in general for the emerging markets, we're seeing prices continue to rise in year-over-year terms, but there are some tentative signs of the pace of growth easing.
And Todd, how are things looking in mainland China?
China's new home prices have fallen for a year and a half because of COVID policy and the government's crackdown on property developers' excess borrowing. Now, since February, housing prices across China began to rise, but there's signs that the price rebound is sputtering. China's Data Bureau conducts this 70 large and medium-sized cities survey of home prices. In October last year, only 10 cities show house price increase. Now in April this year, the number of cities showing home price increase is 62. But then in the month later, in May, it fell to 46 cities. So housing market recovery in China is still nascent and it hasn't firmed up yet.
Now, in previous episodes of our series on housing markets, we've talked about interest rates and how they were driving the cost of housing. And Bree, you touched on monetary policy there. To what extent has monetary policy influenced APAC housing markets? Would you describe it as a significant factor here?
So in this story, a lot has to come down to where the transmission of monetary policy tightening is the quickest. So monetary policy transmission is not always expedient in every economy. To explain this a little less jargony, this often arises in markets where mortgage rates are most responsive to policy adjustments and where the mortgage and personal lending rates are not as structurally high due to risk assessments. So in most parts of APAC, mortgages are typically in floating rate terms, meaning they move alongside the policy rate. The more these mortgage rates move in lockstep with the monetary policy moves, so 25 basis points for 25 basis points, the more impactful the monetary policy tightening has been. So that's why the three markets that I outlined before, which have been through a pretty significant correction already, Australia, New Zealand, and South Korea, this is where the monetary policy transmission has been the most effective and quickest. When it comes to other emerging markets in the region, the policy transmission effect is weaker. This is dampened by structurally high interest rates, but also different savings and borrowing habits of those households versus what we've seen in the Australia, New Zealand, and Korean markets.
And Todd, I imagine the situation is unique in mainland China with monetary policy, yes?
Yeah, China's monetary policy per se does not significantly impact the housing market. Unlike the US, China did not implement a monetary quantitative easing and brought interest rates down to very low levels. Although the massive stimulus the government injected in the economy in the late 2000s and early 2010s, a lot of that went to the housing market to combat the great global financial crisis. So that was sort of an unintended consequence. But in general, housing market is influenced by government's direct intervention in the market, more so than monetary policy. Like the government could raise the down payment requirement for purchase of a second home or lower it. And these intervention policies, they vary across cities based on local conditions. So these are actually much more influential on China's housing market than monetary policy.
And Todd, this might be a good time just to step back and talk about the role that the property sector plays in mainland China's economy. Is it a significant component of that economy as it is in the US?
Yes. Well, China first marketized the housing sector in 1998. And since the marketization, housing sector has grown into this giant sector in China's economy. If we include all the housing-related economic activities, housing sector accounts for close to 30% of China's GDP. And the sector has developed this outsized footprint in China's economy, partly because housing is Chinese households' investment vehicle of choice. And that's because China has an underdeveloped financial market. So housing is viewed by Chinese households as the most reliable asset to park their savings. The other reason is that housing is also local government's main income source. So around 40% of local government income comes from land sales. So this incentivizes local governments to focus their development efforts on the housing market. And because of housing market's outsized presence, the sector's upturn would be a boom to Chinese economy. And when the sector has a downturn, it will weigh heavily on the economy. So this leads to this notion that's widely expressed in press reports and even in some research notes that housing sector is China's growth driver. But the relationship is actually the inverse of that. It's like to say housing market is China's growth driver. It's like saying Silicon Valley has a thriving economy because of this hot housing market, right? I mean, Silicon Valley's real estate market became hot and pricey because of its high-flying tech-oriented economy, not the other way around. So housing market is not a growth driver of China's economy, but a growth passenger. It's grown excessively large and bubbly because of the unique characteristics of the Chinese economy, like the household investment preference and local government financing. So that's sort of the role housing market plays in China's economy.
Really interesting. Bree, what about the markets you mentioned earlier, Australia, New Zealand, and South Korea? Does housing have a significant effect or role in the economies there?
We have to break it down into the component parts to figure out the sum total of it. So if you look purely at residential building construction as a share of GDP, that runs around 5% for Australia and South Korea's GDP. In New Zealand, it's run a little closer to 7 to 8% of GDP in recent years. It doesn't seem like a lot in the grand scheme of things. But then if you take a look at how much private consumption contributes to GDP growth, that ranges from 57% of GDP for New Zealand to 46% of GDP for South Korea. In these economies too, household debt as a share of disposable income is on the higher side. For instance, in Australia, household debt to disposable income runs at about 188% at the end of 2022. And New Zealand and Korea's figures are running close to 170%. So there's a lot of debt tied up in households. So when you have these negative home price corrections, you not only get the weakened residential construction activity as construction starts slow and demand for new construction stalls out, But you also simultaneously see households reprioritizing their spending and moving away from discretionary items to ensure that they can hold on to their homes and pay those debts on those homes. And if we want to take a case in point, if we look at Australia in mid-2018 through late 2019, they had a 17-month-long house price correction where prices were contracting year over year. They troughed at 7.3% year over year in May 2019. During that time period, residential construction deducted, on average, 0.1 percentage point from growth quarterly, from real GDP growth. At the same time, household consumption, which typically contributes 0.4 to 0.5 percentage points to growth per quarter, contributed only 0.1 to 0.2 percentage point to growth. That's less than half. And so as a result, the cumulative effect was that real GDP growth in Australia that year slowed very sharply. It came in at 1.9% for 2019, which was on a par with the economies of performance in 2009 during the global financial crisis. So it had a very stark dampening effect on the broader economy.
Wow, that is a big impact for sure. Let's talk about demand for housing in these markets. What is driving demand? Is it migration? Is it demographics? Is it supply shortages? Some combination of the above, or something else entirely? Bree, let's start with you.
In broad parts of APAC, there are demographic trends. Emerging markets, demographics are going to play a little bit more of a part. More advanced economies, it's actually inward migration. There are economies which are heavily dependent on inward migration to plug labor gaps. So in addition to Australia and New Zealand, which have had significant inward migration over the past decade or two, Singapore, even Hong Kong's market has significant inward migration. The relaxation of COVID-19 protocols has suddenly created a sharp increase in housing demand. This is actually the primary reason for Australia's home prices already stabilizing. There's a lot of incoming demand from foreign students, new expatriate workers hired to fill labor shortages. That's actually stabilizing this market right now. And then when you look at both Singapore and Australia, they also have a perfect storm at hand because they are also facing supply constraints. The strict COVID-19 protocols during the pandemic limited the amount of construction activity as firms struggled to keep up with the demand from households shifting their preferences on housing. Then, as the economies exited the COVID-19 protocols, we had a combination of higher construction material prices coming online and then continued labor shortages constraining the growth in housing construction output. So as a result, there's this undersupply of available housing contributing to house price pressures. And I didn't mention Singapore at the top of the podcast, but Singapore's housing prices recorded growth for essentially 12 consecutive quarters in a row now through the first quarter of this year because there's just consistent demand and undersupply in Singapore. And a final note on the supply side, one thing to consider for some of the region's largest cities, there's a lot of geographical constraints on where they can build further. And then there's building regulations as well as to where you can build, which are really limiting the physical space for cities to expand or maybe even expand upwards with more high capacity apartment and condominium style accommodations. So all of these factors are all playing together in the housing markets in APAC.
Wow, lots to unpack there. 12 consecutive quarters of growth in Singapore. Sounds like I should have gone back in time and bought a home there 10 years ago.
Indeed.
Yes, in the earlier episode that we did on the US, Canada, and European markets, I missed the boat on my Texas ranch as well. So Todd, what about in mainland China? What are the drivers of demand in that market?
Well, the rapid economic development is the key fundamental driver for China's housing sector. The other fundamental driver is urbanization. When China first marketized the housing sector in 1998, only around 30% of its population live in cities. By 2022, urbanization rate rose to 65%. So this means that over that time period, around 500 million people moved from the countryside to cities. So that has been one of the key drivers for this very long run of rapid growth in the housing sector. The other driver for demand is the households' preference to invest in the housing market that I mentioned earlier.
Wow, 500 million people. That's the entire population of Europe, basically, moving from the country to the cities. That's huge, huge number. So staying with you, Todd, what kind of policy responses have you seen from mainland China's government on housing? I mean, you touched on some of these earlier. I don't know if you want to expand on any of that or add to any of that.
Sure. The downturn that the sector is trying to recover from, it was triggered by the so-called 3 red lines policy. We don't need to get into the details that the central government launched in August 2020. The purpose of that policy is basically to constrain property developers' excess borrowing, because it became clear that was going to pose risk to China's financial system stability if they allow that to continue to run its course. And since late last year, the government has begun to ease housing market policies, and the easing vary across cities, like I mentioned. And so it's kind of the tuning policies. And some of the measures they already discussed is like lowering the down payment requirement for households to purchase a second home. So kind of encourage investment by households in the housing market again, things like that. More broadly speaking, in recent years, the central government launched a strategy called, quote unquote, housing is for residential use, not for speculation investment. So they're using this strategy to anchor China's housing market policies. So that sort of gives you a notion of the overarching theme that the central government is trying to steer the housing market.
And Bree, what about in other markets within APAC? What kind of policy responses have governments pursued on the housing front that impact the sector?
Yeah, so what we've seen so far is there's a lot of tinkering on the margins by policymakers. So adjusting a number of policies in small ways because they're trying to work towards incremental solutions to help the markets hit their troughs without making existing affordability problems worse. So, for instance, South Korea's government has adjusted its policy on taxation for those folks who can currently own 2 homes, again, kind of maybe encouraging homeowners to make that second house purchase if they don't think they can sell their original home right away. They've also eased some of the lending rules for first-time homebuyers, single homeowners, among a number of other policy settings. When we look at New Zealand, the central bank there has eased the loan-to-value ratios as of the 1st of June. In doing so, what they are doing is allowing banks to marginally increase the size of their loan books to households with low deposits. So under these rules, for owner-occupiers, people who are buying the house to live in it, they have to have a deposit of at least 20%. If they have under it, that's where they fall into this loan-to-value ratio rule. And it's a 35% ratio for investors. One of the bigger moves in the region is Singapore raised the stamp duty for foreign buyers from 20% to 30% if they are buying private residential properties. And this is in order to dampen foreign buyer activity. And this is actually a trend we may want to keep an eye on over the next couple of months in Singapore and beyond. But also in Singapore, they did raise the stamp duties for citizens and residents owning 2 or more properties. Again, Singapore, with its growth in prices continuing, these policies make sense for Singapore. Some other big nameplate initiatives came out of Australia and New Zealand's budgets in May this year. Both of these initiatives are really more solving possibly long-term supply issues and really won't resolve current issues, but just to name them, in New Zealand, they have the Going for Housing Growth program, which focuses on zoning new land for construction, encouraging investment into infrastructure for those new housing developments, and financial incentives for the local housing councils to approve new developments. Australia has the Housing Australia Future Fund, which aims to build 30,000 new social and affordable housing properties in the first 5 years of operations. This initiative, I will flag, has already hung up in Parliament due to a lack of support from outside the government. And truthfully, 30,000 affordable homes is probably way below what the market actually needs. We'll wait to see the outcomes on those, but those are really two longer term solutions and not immediate term solutions.
It's a delicate balance there for governments across the region and across the globe, really, balancing economic growth with access and affordability. So how are these housing market trends that we've been talking about, how are they impacting businesses? Why should our clients care about what's going on with housing markets right now? Bree, let's stay with you.
Sure. So one area to look at where we do get questions is the banking sectors. The banking sectors in particular to the three big markets we've already discussed. Those three, Australia, New Zealand, Korea, are well regulated, well capitalized. Outside of these economies, we are seeing banking sector regulators either already implementing or in discussions to implement additional capital requirements for banks and additional countercyclical buffers to bolster the banking sector and the banks in this period of slower economic growth, weaker interest in mortgages, and tighter liquidity. Outside of the banking sector, obviously, we're going to see weakness in construction materials as there's just not a lot of demand until that demand solidifies again in the next couple of months to years, depending on the market. I think really, truly, again, for the economies I've already flagged, the bigger issue is on the household side. Expect a lot of pullback in demand for high-ticket durable goods by consumers, cars, appliances, etc. And then in the next couple of months, too, we might start seeing more and more pullback on discretionary spending, even on services like dining out, going to the theaters. Those areas are spending which have done pretty well so far this year, but we should see some more pullback. And then the last thing to keep an eye on, if you are hiring people in these economies, expect higher wage demands for higher costs of living, especially in those economies where there are dramatic and notable shortages of housing and rental stock, because your workers that you're either bringing in from abroad or hiring domestically are going to need somewhere to live, and they are going to require extra compensation to be able to live in the areas where they work.
That last point you made about higher wage demands, that was a point that came up in our earlier podcast episode on the US, Canadian, and European housing markets as well. Todd, how about in mainland China? Why should businesses there care about what's going on with the housing market? Do you see similar concerns there, like on discretionary spending, for example, that Bree highlighted?
Yeah, certainly, because housing market's outsized presence in China's economy that we discussed earlier, so it plays a key role in China's post-pandemic economic recovery. The housing sector's prospects of recovery will impact China's overall economic recovery significantly. And also housing market or housing sector plays a huge role in China's commodities demand. That will impact our clients who work in that sector as well. And because of the housing's large share in the household wealth, so it impacts households' willingness to spend. So as a result, it impacts the consumer market recovery as well.
So what do you see as the main risks in the markets that we've talked about today? What signposts should people be watching out for? Bree, I know you mentioned that we should be keeping an eye on the market in Singapore there. What other potential risks or signposts should people be watching out for?
Beyond the traditional signposts to watch out for, which is non-performing loans, where available, definitely keep an eye on the data provided by central banks and regulators on loans that are 30 to 89 days past due, because those are the loans that are at increasing risk of becoming non-performing loans in the near future. That's a straightforward one. Other issues to keep an eye on is further increases in the policy interest rates. Broadly speaking, in APAC, monetary policy tightening is finished, but keeping in mind that between June 2021 and June 2023, New Zealand has implemented 525 basis points worth of monetary policy tightening, Australia 400, and South Korea 350 basis points of tightening. Any further tightening in any of those three economies is going to have a pretty significant impact. Of those three, Australia is the one most likely to implement further tightening, as the central bank there has only really shifted back recently to a hawkish tone on inflation. Another key signpost that I'm keeping an eye on is what I've termed and other people in the market have termed the fixed rate mortgage rollover cliffs. So while the mortgage markets are largely dominated by floating rate mortgages, a higher proportion of borrowers over the past several years have shifted to fixed rate mortgages, especially while interest rates were especially low. For those households that locked in significantly lower fixed rate mortgages in the past 1 to 3 years, there is going to be a significant increase in their monthly mortgage costs when they come back to refinance those fixed loans. So for those households, what they may wind up doing is instead of locking back into another fixed rate mortgage, they may start shifting to floating rate and even interest rate only floating mortgages for a period of time until interest rates come back down a little bit. Even with switching to a floating rate mortgage and an interest payment only mortgage, these households are facing monthly mortgage payments that will be considerably costlier than when they last locked into a fixed rate mortgage.
That was the fixed rate mortgage rollover cliff. Is that?
Yeah.
Yes. All right. Todd, what about in mainland China? What do you see as the main risks to the market there, or any particular signposts that you're watching in that market?
Yeah, beside the property developers' excess debt, I think a key risk to the current recovery is households' housing price expectations could turn materially negative. Now, households' housing price expectation had been persistently positive, over the last 20 plus years because of the very rapid development of the housing market and very robust development. Now, the policy strategy that I mentioned earlier, housing is for residential use, not for investment speculation, that anchors China's housing policies. That could sort of render the current easing policies, like lowering the down payment requirement for second home, ineffective, because households would not believe that these policies will have a staying court or that will become persistent, right? So whenever the market shows any signs of rapid growth again, the central government could turn the policy around because of this anchoring strategy, right? That will keep investment repressed or investment in housing repressed. That's the key risk to the current recovery. In terms of signposts, I would say to monitor this, I would say housing sales, mortgage growth, housing prices in tier 2 and tier 3 cities, because housing prices in tier 1 cities like Shanghai and Beijing, they're very resilient. So the housing price developments in the tier 2 in the lower tier cities, that's bear watching.
So we've covered a lot of ground today. Let's wrap up with some top takeaways for our listeners in 30 seconds or less, a little bit of a lightning round here. What is one or maybe two key points you'd like listeners to take away today? Todd, let's stay with you.
So because housing market is a growth passenger of China's economy rather than a growth driver that we discussed earlier, so to fundamentally address China's housing sector issues, besides the intervention policies on the sector, what China really needs to do is to implement economic reforms to revitalize productivity gains and restore robust economic growth.
And Bree, how about you? Top takeaways for our listeners today.
So first up, monetary policy tightening has had a quick and significant impact in a handful of housing markets in APAC so far, but keep in mind supply and demand issues may result in the trough in home price declines being met earlier rather than later, but definitely not without exacting some economic pain. And then furthermore, there's still a little more room for other markets, notably the emerging markets, to slow, considering the tight liquidity conditions that are still likely to persist through the end of this year, which could flow on to household demand for additional housing.
All right. Well, thanks again for sharing your insights with us today, Bree and Todd. And thanks to our listeners for tuning in. Please join us next week when we will dive deeper into the forces at work in 2023. And please check out our earlier episodes on housing markets if you haven't already.
Thank you for listening to the Economics and Country Risk podcast. Connect with us on LinkedIn and Twitter and don't forget to subscribe to the podcast so you never miss an episode.